Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The collapse of crypto exchange FTX has spooked a lot of people, with tens of thousands of Australians among investors losing their money. And that wariness goes beyond cryptocurrency. Even investors in traditional share markets seem to be getting just a little nervous. I wanted to look today at what protections are in place for equity investors. Chris Brycki is the CEO and founder of online investment advisor Stockspot. Chris, welcome back to Fear and Greed.
Thanks, Sean. Thanks for having me back.
You're seeing a rise in queries from customers asking how you keep their shares safe. That's a pretty reasonable question given the current climate. Wouldn't you agree?
That's right. I mean, we've had a year of volatility, but actually the increase we've seen more recently on inquiries is really related to a lot of the crypto mayhem that's been happening out of the US and coming across to Australia as well. And some of these big exchanges that a lot of people trusted to have their money stored and have their crypto assets stored going belly up, I think really concerns people, and it makes them think, what about all of my other investments? How safe are they? And what could happen if the companies managing those went belly up?
Okay, so what does happen if a brokerage, an equity brokerage, goes under?
Well, it's a good question, and it's different actually based on the broker that you're using in Australia. So typically shares or ETFs or whatever you're investing in on an exchange in Australia, the assets can be held in one of two ways. So the traditional and most safe way is for your assets to be held on what's known as a HIN, a holder identification number, which is basically a number that's your own number that then the sub-registry maintains a register of what you own. And then in the event of your broker or your financial advisor, for that matter, going bankrupt, nothing is really going to happen to your investments apart from you having the ability to transfer them to another broker or another financial advisor, because your broker advisor never has ownership or custody over those investments. So that's quite common, and a lot of the stockbrokers use that. I mean, we certainly use that at Stockspot because we think it's the safest thing to do for clients. Then on the other side of the spectrum, you have custodian-based models, and this is where typically a whole bunch of different client investments are held together in one account. And then someone, and it could be your broker, or it could be your advisor, or it could be a third party, is basically doing the accounting for who owns what. So they'll have a sub-register or a tally of how many shares belong to person A and person B and person C, and it's their responsibility to really maintain that. But what we've seen from FTX and some of these other blow-ups in Australia in the past and around the world is sometimes that business managing the register isn't doing the right thing. Sometimes it's borderline fraud or, very obviously wrong, or sometimes they just make mistakes and they accidentally miscount. But it adds an extra level of risk when you own investments in that sort of model.
So have we seen that custodian model in Australia very much? Is it very prominent in Australia? And have we actually seen people lose their money because that model, the custodian themselves, have gone bankrupt?
We have. And so typically, and this, I guess, is common in all markets, typically a lot of these blow-ups happen at the end of the boom of the share market cycle. And clearly this FTX example happened at the end of the crypto boom. So back in 2007, 2008, and the few years that followed, there were quite a few of these blow-ups in Australia. And not all were entirely related to this custody model, but a lot of them had that in common. And these included businesses like Storm Financial, Opus Prime, MF Global was quite a well-known global example. And more recently, a stockbroker called Halifax, only a few years ago, went into administration, and $200 million of client assets were basically unaccounted for and needed to be found. And so unfortunately it does happen, to the extent that we've seen it for FTX in global crypto markets. I mean, that's an enormous example and one that I'm sure there'll be books and movies made about in the future. But yeah, unfortunately, it's an example, and a combination of greed and incompetence usually leads to this sort of thing happening. But it's something I think all investors need to be aware of, is that when you're investing, you've got two risks. One is the risk of whatever you've invested into, that BHP share price could go up or down, or the ETF you've bought could go up or down. But then you've got the risk of who's holding those investments for you, and that's a risk. I mean, I think it's much safer to eliminate if you can.
Yeah, so I mean, the CHESS sponsorship or the HIN is a way of really eliminating that risk. Is that correct?
It is, yes, because you become not only the beneficial owner of those investments, which means you have the rights to the assets, but you become the legal owner of those assets. So in the event that your stockbroker advisor goes bankrupt, you don't become a creditor to that business and basically be forced to chase after your assets. They've never gone out of your hands in the first place. So, and there's other benefits of that model as well. Tax benefits, I think, is one that people don't appreciate, that well. But the benefits, I think, are quite large, and the cost really of having your assets held under that CHESS or HIN model in Australia is not that high these days. So in the past, brokerage costs to own your shares under that model were very high, and for some of the traditional brokers, they still are quite high, in my opinion, compared to other parts of the world. If you're paying $20 or $30 brokerage, that's long gone are the days that you should have to pay that amount in brokerage. But these days, the real costs of that model, from what I've seen, is probably something like 0.1% per year to 0.2% to have your investments held on a HIN. And if you think of it like insurance, a lot of other things you insure, like your house or your car, you pay a lot more than 0.1% of the asset value to insure it. And so it seems pretty good value to me.
Stay with me, Chris. We'll be back in a minute. I'm speaking to Chris Brycki, CEO and founder of online investment advisor Stockspot. Okay, now I want a bit of a 101. We talk about CHESS sponsorship, and what I'm trying to get to is the fact that ASX has ditched its CHESS clearing and settlement replacement project. Can you explain CHESS to me up front, and then what the ASX was trying to do?
Sure. I mean, I can try. So the CHESS model is really just a registry that maintains a ledger of everyone's investment holdings. So when you buy a share on the ASX, it will be lodged in this register. And then what you'll often notice is you'll receive a mail or, hopefully these days, something electronic if you're trying to save paper that says you now own 10 units in whatever it is that you've bought. And then when you sell it, you'll receive an update that says that the ledger or the registry is updated and you've now sold that. But there's basically, a ledger that's maintained that accounts for all the ins and outs for each of your holdings. And at any point, you can go and query the ledger to find out what you own. So one of the big projects that ASX has been working on for quite a period of time now is trying to improve the technology that sits behind that ledger. And, I know cryptocurrency and blockchain have become very popular sort of topics to talk about. Now, this was a real life user case that the ASX identified that could actually improve a process by using blockchain technology. So they invested a lot of resources into trying to build a blockchain version of this register, which ultimately has not been successful. And I think it's been in the news recently that they're writing off something like $250 million from that project, and they're going to have to rethink what they're going to do there.
So has ASX more or less got a monopoly on that as a clearinghouse?
Compared to other markets, they do have a lot of market power in Australia. So in other exchanges in the world, the power is really shared between a lot of different exchanges. The US is a good example where you've got a whole bunch of different exchanges competing for volumes, competing for listings. In Australia, the majority is going via the ASX. There are some smaller competitors, but realistically, they have a pretty good stranglehold over that.
Okay, because I'm going to get it wrong, but I think the Reserve Bank and perhaps ASIC have been slightly critical of the ASX and the fact that the technology hasn't improved. Is it something that over time blockchain might actually play a role in improving that? And ultimately, it should be about the investors getting a better service. And I figure kind of if we can push it forward from what the ASX is doing, be that by the ASX or others, we may end up in a better place.
That's right. So I think there's a view clearly by the regulator and probably from a lot of market participants that this was a project that could really benefit end consumers, because if you could create a blockchain version of this, it could further reduce the administration costs involved in this register. And therefore, those costs could then be passed on to consumers. So from reading a lot of articles about this, there is some level of cynicism around how motivated the ASX was to actually deliver a successful project here, because as the monopoly that benefits from all of the trades and transactions going through your exchange. How motivated really are you to make things more efficient and reduce costs? I think that's a question that's going to sort of continue to be out there, and it might be one that the regulator, looks into further. But theoretically, at least, yes, I think there is an opportunity to use these new technologies to manage some of these processes in a more efficient way. Maybe ASX got its execution wrong. Maybe the timing was just too early. I think, a lot of that will be unpacked and discovered over the next little while. But yeah, the cost that I mentioned of, let's say, 0.1 or 0.2%, for an individual investor is not that large, but when you multiply it by all of the trades and all of the volumes that are going through the ASX is a large number overall. And I think there is certainly an opportunity to keep on passing on lower costs to the end investors in Australia.
Chris, I can't let you go without asking you at least about the market. It's kind of, the last few sessions have been a bit quieter, but it's actually had a pretty good run the last few weeks.
Yeah, I think, the last time we spoke, the market was probably very shaky and there was a lot of negativity out there. What's interesting is that particularly the Australian market has done pretty well this year. You've seen all of the negative headlines around the world of tech shares crashing and all of the job layoffs, but the Australian market is back up at 7,200 or so. That's not too far from its all-time highs. The banks are doing really well at the moment. They're benefiting from higher interest rates and higher interest margins. The resource companies are doing well because commodity prices are up. So actually, our market is doing very well compared to others around the world. And it's a bit of a change from the last few years where tech and biotech was sort of leading the charge. Banks and resources are taking the lead globally, and that's helping our market. So I think when investors look at their returns at the end of the year, provided they were diversified across different sectors and, weren't trying to, pick the latest, technology stock or cryptocurrency, they may see that their portfolio is only down a little bit, which is actually pretty amazing in the overall context, because when you look at it from a global sense, this was the worst year in 100 years for a balanced portfolio. And by that, I mean a portfolio split between shares and bonds. Now, in the US, both shares and bonds are down over 10% this year, which is the first time that's happened in 100 years. So, by all measures, it was a pretty horrendous year for investors, but a lot of Aussie investors are actually doing not too bad at all.
Chris, thank you for talking to Fear and Greed.
My pleasure. Thanks for having me back.
That was Chris Brycki, CEO and founder of Stockspot. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.